Hi. Let's learn about financial statement analysis. Financial statement analysis is the process of analyzing a company's financial statements for decision-making purposes. External stakeholders use it to understand the overall health of an organization and to evaluate financial performance and business value. Internal constituents use it as a monitoring tool for managing the finances. In general, financial statements are centered around generally accepted accounting principles in the United States. These principles require a company to create and maintain three main financial statements: the balance sheet, the income statement, and the cash flow statement. Public companies have stricter standards for financial statement reporting. Public companies must follow GAAP, which requires accrual accounting. Private companies have greater flexibility in their financial statement preparation and have the option to use either accrual or cash accounting. Several techniques are commonly used as part of financial statement analysis. Three of the most important techniques are horizontal analysis, vertical analysis, and ratio analysis. Horizontal analysis compares data horizontally, by analyzing values of line items across 2 or more years. Vertical analysis looks at the vertical effects that line items have on other parts of the business and the business's proportions. Ratio analysis uses important ratio metrics to calculate statistical relationships. Companies use the balance sheet, income statement, and cash flow statement to manage the operations of their business and to provide transparency to their stakeholders. All three statements are interconnected and create different views of a company's activities and performance. The balance sheet is a report of a company's financial worth in terms of book value. It is broken into three parts to include a company's assets, liabilities, and shareholder equity. The balance sheet must balance assets and liabilities to equal shareholder equity. This figure is considered a company's book value and serves as an important performance metric that increases or decreases with the financial activities of a company. The income statement breaks down the revenue that a company earns against the expenses involved in its business to provide a bottom line, meaning the net profit or loss. Basic analysis of the income statement usually involves the calculation of gross profit margin, operating profit margin, and net profit margin, which each divide profit by revenue. Profit margin helps to show where company costs are low or high at different points of the operations. The cash flow statement provides an overview of the company's cash flows from operating activities, investing activities, and financing activities. The bottom line shows how much cash a company has available. Companies and analysts also use free cash flow statements and other valuation statements to analyze the value of a company. Free cash flow statements arrive at a net present value by discounting the free cash flow that a company is estimated to generate over time. Private companies may keep a valuation statement as they progress toward potentially going public. Financial statements are maintained by companies daily and used internally for business management. Both internal and external stakeholders use the same corporate finance methodologies for maintaining business activities and evaluating overall financial performance. When doing comprehensive financial statement analysis, analysts typically use multiple years of data to facilitate horizontal analysis. Each financial statement is also analyzed with vertical analysis to understand how different categories of the statement are influencing results. Finally, ratio analysis can be used to isolate some performance metrics in each statement and bring together data points across statements collectively. Financial statement analysis evaluates a company's performance or value through a company's balance sheet, income statement, or statement of cash flows. By using a number of techniques, such as horizontal, vertical, or ratio analysis, investors may develop a more nuanced picture of a company's financial profile. An analyst may first look at a number of ratios on a company's income statement to determine how efficiently it generates profits and shareholder value. For instance, gross profit margin will show the difference between revenues and the cost of goods sold. If the company has a higher gross profit margin than its competitors, this may indicate a positive sign for the company. Here are 3 key takeaways. 1. Financial statement analysis is used by internal and external stakeholders to evaluate business performance and value. 2. Financial accounting calls for all companies to create a balance sheet, income statement, and cash flow statement, which form the basis for financial statement analysis. 3. Horizontal, vertical, and ratio analysis are 3 techniques that analysts use when analyzing financial statements. Hope this would help. Thanks for watching.